How do you think about allocating between public and private credit? And how do you think about things like liquidity, transparency, credit risk? How does that tilt the balance of your allocation policy?
There's so much discussion around private markets today. And it's true that more issuers, more types of investments are being distributed in a private manner relative to what we would consider a public investment. But these are not new markets. In fact, when I joined PIMCO almost 30 years ago, some of the first assignments I had were to underwrite private type investments, 144As, secured debt with various forms of corporate guarantees or other make-whole guarantees, other off-the-run structures, particularly in the asset-backed and the asset-based area of the market. In fact, even before PIMCO, focused a lot, as you know, on asset-backed type investments. So there have been a few decades of performance here. And I think just a few points that I think are important to note. One, these are highly related markets. I think rather than just talking about public and private, I think it's important to look at investments on two different continuums, one liquidity and one economic sensitivity. There are areas of the market, the private market, where there's very little to no transaction liquidity. No ability to exit that position. And although there have been discussions about liquidity convergence in markets, a good portion of the private space requires the borrower to give you permission to sell an instrument. There's limits to how much convergence you can have if you actually have to ask for permission to sell at some point in the future. Those investments should warrant a more significant pickup in spread relative to their liquid alternatives. And then in other areas of the private opportunity set, there's pretty significant transactional liquidity. There's no practical reason why you cannot source risk, create risk, work with issuers looking to access these markets in a manner that doesn't preserve material liquidity. And in those areas, again, the requirement for liquidity compensation can be less. So I think investors have to take a look and make apples to apples comparisons. And I think there's some interesting value that can be uncovered by being very, very careful to make those precise comparisons. And the bottom line is equity valuations are stretched. There's a lot of money moving into private assets. A lot of the players in that space seem to at times be competing based on market share as opposed to the underlying value proposition. So not surprisingly, the average pickup for going down the liquidity spectrum fairly narrow, but very, very different depending on what areas of the market or what particular investments you're targeting. And the whole point of what we're trying to do on behalf of investors is look to ensure that we get an appropriate level of compensation for the relative liquidity. And a lot of that takes very, very careful underwriting of increasingly complex transactions. On the economic sensitivity piece, we're most cautious about the more economically sensitive areas of the market. No different than our public portfolios, where we have been reducing credit exposure to more economically sensitive areas, things like senior secured bank loans, things like the high yield market, although the high yield market's a much higher quality market than it's been in the past. Same view within the private opportunity set. Be very, very careful about the more economically sensitive areas of the market where companies are running much higher leverage, older economy companies that may have relatively high cash flow today, but are susceptible to being the victims of disruption, tech disruption, AI disruption, ongoing challenges, in terms of private equity sponsors themselves that are being very aggressive towards that segment of the market. At the other end of the extreme, the higher quality areas of the market, asset-backed, asset-based lending, areas where we're quite overweight in both our public strategies, our hybrid strategies, and our private strategies, we think continue to make a lot of sense. The household balance sheets of the U.S. and Europe and some other parts of the world have strengthened significantly over the course of the last several years. Underwriting quality has been very, very strong, absolute. And relative to what you're seeing in the corporate credit market, because of the post-global financial crisis regulations that were so severe, and you've had multiple years of deleveraging and strengthened housing markets. So mortgage-related risk, consumer lending, other forms of collateralized lending when underwritten properly make a lot of sense as well today. Now, the only caveat there is that financial engineering, ratings-based capital optimization is beginning to increase quite significantly. Reminds me of the mid-'90s, then the mid-2000s. So everything's not great simply because it has an IG rating. Everything isn't appropriate just because it has the label asset-backed or asset-based. So from the standpoint of generating active returns through investing rather than simply deploying capital, we do think you can continue to provide significant additional incremental returns versus passive alternatives or some of the more narrow strategies that have done well, when beta performance was strong, but where I think it's going to get a little bit more challenging going forward, given pretty full starting valuations and at times not the type of covenant protections that we would like to see on behalf of investors as prudent credit underwriters.